All right, we're close to the top of the hour. So, good morning, everyone. Thanks for joining us today. I am Dan McIntosh, Chief Growth Officer here at Brady Marts, and we're really glad that you could be here today. So, today's session is all about the One Big Beautiful Bill Act and the tax changes that come with it. It's going to be a lot of information packed into this new legislation. Our goal is to really help break it down, explain what matters most, and help you start thinking about the next steps. I'm excited to be joined by two of our experts, Jake Franklin and Zach Plant. They're going to walk us through the details and share their insights on what this means for businesses and individuals. Just a couple quick housekeeping notes before we dive in. This webinar is being recorded. We'll be sending out a link to everyone who registered so you can rewatch it or share it with others. If you have any questions during the session, please drop them into the Q&A section. I'll be keeping an eye on that and making sure that Jake and Zach see what's coming in. Finally, we will share our contact information right now and also at the end of the presentation so you can follow up with us directly if more questions come to mind later. With that, we will jump right in. Zach, I'll hand it over to you.
Perfect. Thank you, Dan. We've got a big group listening in, so feel free to send in those questions. I'll answer them as quick as we can. Today is all about the One Big Beautiful Bill that President Trump signed into law back on July 4th in vintage Trump fashion. Kind of the background and how we got to this point was back in 2017. Trump originally passed the Tax Cuts and Jobs Act, and that went into effect for tax year 2018. But majority, if not a lot of the provisions of TCJA are going to start sunsetting at the end of this year. So with the One Big Beautiful Bill, a lot of that was extended or made permanent, maybe some modifications, maybe some removals, plus some new stuff with some of the campaign promises that Trump had. We joke it is called the Big Beautiful Bill for a good reason, just for the pure volume of material that was in that bill. It's massive. There was a lot of tax that was touched in there, even non-tax provisions that were modified in the bill for funding, etc. So we're just going to focus on what's going to affect most people. Some stuff might apply to you, some not. So just bear with us as we go through each and every slide. And that's kind of our caution is when we use the term permanent, we're talking with tax law. It's only could be as permanent as tax law could be. All it takes is another bill by Congress to modify the code. But there just is no current sunset on the horizon for some of those provisions. Okay, so we'll kind of break this down into two sections, focus on individual side, and then we'll break it down on the business side. So starting at the top, probably one of the biggest things that affects everyone is that there was a straight extension of the preferential tax rates and brackets from TCJA. So those are now permanent. Those were set to sunset at the end of this year and go back to pre-2018 tax rates. So it hypothetically would have been probably one of the largest tax hikes in U.S. tax history if that extension did not take place. And it kind of got a good kind of breakdown here, kind of showing a good comparison of we've got 2025 rates of what we have this coming up tax year, and that highest tax bracket is up to 37%. If the One Big Beautiful Bill, for my acronym, I call it OB3. So if you hear me saying OB3, that's what I'm referencing. If OB3 had not been passed, we would have saw all these going back to 2017 tax rates. And you can see as we go down the line as income climbs for a married couple, most families would have saw tax rates increase. The largest jump would have been in this income range. If you're in that 300 to 400K tax range, you would have saw a 9% increase. And then there was a small little bit savings up in the $500,000 where you actually saw a little bit of savings. But all in all, it would have increased for everyone there. The standard deduction is now permanently doubled. So we have this higher standard deduction that is now permanent and will adjust for inflation. So for a married couple, you get the free $31,000. Most of you should know what the standard, but if you don't, either get the free standard deduction, or if you've got your more itemized deductions, you can use that as well. Okay, so we're going to start getting into some of the new kind of tax deductions that Trump promised on his campaign. One was the new auto loan interest deduction, or if you're buying a new vehicle. And this is not an itemized deduction. It's actually going to be a deduction below your standard or itemized. So it's going to be a below the line deduction. And when we talk about the line, adjusted gross income is the line. But to be eligible, it's max up to $10,000 of interest you can deduct. It's got to be a new vehicle. So it can't be used. It can't be new to you. It's got to be brand new off the lot. And this is a temporary deduction. And it's only from 2025, so now through 2028. And it's got to be personal use. So if it's a business vehicle, you're already deducting any interest associated to that business vehicle in your whatever return you've got going on there. The bank loan has to be the first on the lien. And a huge thing, right, as Trump kind of campaigned, he wants to see domestic production inside the United States. So this is only for vehicles that were assembled in the United States. So you can actually check the VIN number and to see where that vehicle is actually assembled. So the first digit on a VIN of a vehicle tells you what country that car was finally assembled in. So like for the United States, I believe it's like digits 1, 4, and 5. Other than that, Canada is like 2, Mexico 3, etc. So got to be manufactured or finally assembled in the United States. It's got to have curb weight less than 14,000 pounds. This doesn't include side-by-sides or campers. And then the phase out. So as soon as your income climbs over 100 grand for single or double that for married filing joint, you start phasing out and losing on that benefit. And the loan companies will actually send out a Form 1098 that includes all of this information for you to claim this. And the VIN actually has to get reported on the tax return as well. There's a new Schedule 1-A that the IRS just released a draft form, and we'll kind of show a clip of that here later in the slides, but that's where that deduction will get reported. Another new temporary deduction from Trump's campaign promise was trying to not have taxes on Social Security. But the one big beautiful bill was what we call a budget reconciliation bill. So they weren't able to modify it technically to not tax Social Security benefits. So they created this extra new senior deduction. So it's only going to be around for, again, tax years 2025 through 2028. You'll kind of see this common theme of these new these new deductions are only going to be around for the next four tax years. And it's for seniors that are 65 and older. So if you are starting to draw Social Security early at 62 or 63, you will not qualify. It's got to be 65 and older. And again, it's going to start phasing out as AGI climbs again at 75 grand and double that for married. And then it'll fully go away once you get those above those thresholds. Okay. SALT tax, so state and local tax. This is an itemized deduction. Back in 2017, the original TCJA put a cap on how much individuals were able to deduct for itemized deductions, and that cap was $10,000. And that cap was a heated topic amongst high income tax states such as California and New York. Not so much here in North Dakota or South Dakota. But they wanted a higher cap for their constituents. So a lot of California representatives and New York representatives, whether they were Republican or Democrat, really fought to modify this to benefit their constituents. Now with OB3, that SALT cap will climb to $40,000, and that'll start in tax year 25. And again, this is temporary through 2025 through 2029. And as income climbs again, there's another phase out where that SALT cap of 40 will start climbing back down to 10,000. And that phase out starts at about $500,000. And it'll phase all the way down to 10, but it won't go below that. PTE, probably worth to mention that PTE is still going to be a thing. If anyone is familiar with the pass-through entity tax deduction, OB3 did not eliminate PTE. There was talks where we thought it might, but PTE will be here to stay. So I know I've probably got some Minnesota listeners on the call, so that is still a thing. Mortgage interest, so another itemized deduction. TCJA made the change where eligible mortgage debt went from 1 million down to 750K. And that meant for every dollar you started going over that eligible debt, you started limiting what you were allowed to deduct for mortgage interest. And it also eliminated the use of HELOC debt. as a Schedule A itemized deduction. Instead, the HELOC debt had to be tied to an improvement of the house itself, whether it's expansion, an addition, a betterment, etc. Prior to TCJA, you could take out a HELOC and buy a boat or an RV and deduct that as mortgage or Schedule A mortgage interest. But now with OB3, it's permanently the HELOC interest is no longer deductible unless it's tied to the personal residence itself. Good thing to remind people is, if you still take out a HELOC and use those funds to go and buy into a company, buy stock, whatever it is, there's interest rating rules and you can make the 10T election to tie those funds to that investment. So that instead of personal interest, you've now recharacterized or reclassed it to investment or business interest. So always keep that in mind and that's with any debt too. Okay, big thing for gambling losses is historically with gambling losses, you can deduct them as an other itemized deduction, and you can deduct them up to the extent of your gambling winnings. Well, now under OB3, starting in 2026, that gambling loss limitation now drops to 90% of your gross gambling winnings. Why that was tossed in there, we don't know. So kind of some dollar amount examples. So if a taxpayer had gross winnings of 100 grand gambling, but they lost 120, so they were down 20K. For tax purposes, they'll get limited to only allowing 90,000 of itemized deductions. So their taxable income went up 10, even though they lost 20. And kind of you can extrapolate this to larger. If a taxpayer won 200 but lost 300, so net 100, they'll get limited to 180,000 of itemized deductions, creating 20 grand of taxable income, even though they lost 100. Nevada is not happy. So Nevada representatives have already put a bill in place or put a bill or introduce the bill to fix this. So we joke if you are a big gambler or you know somebody, call your local representative, but can't do much today. I suppose they're off today during the governmental shutdown. So we'll see what that gets fixed. If there's anybody with big lobbying power, it is the casinos. So they will be pushing pretty hard to get that fixed. There are new charitable contribution deduction limits that are going to be in place starting in 2026. There's a new floor limitation. And when we say a floor limitation, it means you have to get over that floor before you can start including that as a deductible itemized deduction. So now there is a 0.5% charitable deduction floor for Schedule A. And it looks at your adjusted gross income. So for an example, if a taxpayer has $100,000 of AGI and they donate $5,000 for Schedule A itemized deduction purposes, they get clipped 0.5% of their AGI, $500. That is just gone. So only the dollar amount in excess of 500 will be allowed. So this specific taxpayer would only be deduct $4,500 of their $5,000 charitable contribution. Why that was targeted, I have no idea why Congress would want to put limits on charitable deductions. And again, just a reminder, there's no carry forwards. It's a haircut, and those deductions are just gone. If you're very charitably inclined, it might be worthwhile to look at accelerating and bunching donations together into 25, so that you do not lose out on those deductions. If you're a very high income taxpayer, and you're very charitable inclined, you might get hit pretty good by this. And then C corporations, they now added a new 1% floor limitation of taxable income as well. And that's separate of the normal charitable contribution limit of 10% as well. So for non-itemizers, they brought back if you're still donating, they brought back from 2020 or 2021 during the COVID years, you could take an above the line or in addition to the standard deduction, a charitable contribution. And that's up to $1,000 and $2,000. So any tax preparers listening on this call will have to be asking all clients, did you make any donations if they historically have not itemized? And that'll start in 2026 and going forward. There's no AGI limitations. It's just in addition to the standard deduction, they can claim a charitable contribution deduction. A new kind of modified overall itemized deduction limitation is going into effect in 26. Prior to TCJA, there used to be what was called the PEAS limitation. That was a kind of a goofy calc that went through and limited overall itemized deductions for high income earners or high taxpayers. Um, that went away with TCJA and it's permanently gone with OB3, but they replaced it with this new limitation. And essentially, at the front of it, it's the high income taxpayers that get to that max tax bracket of 37%. They essentially can't benefit off of itemized deductions at that 37% rate. They can only benefit at no more than 35%. So to kind of look at this with some numbers, if a single taxpayer's got 100 grand of overall itemized deductions, they have taxable income of 700. So the dollar amount in excess of the 35% bracket is 90,650. You take the lesser of that or their itemized deductions, and you take it with a hair clip of that 2/37. So essentially, right, it's the benefit to get it down to the 35% bracket. So this taxpayer would actually lose out on 4,900 bucks of itemized deductions. Similar to the charitable contributions, again, look at maximizing your itemized deductions in 25 if you're looking at to get away from that hair clip. If that's, prepaying your personal real estate taxes, stuff like that. Again, bunching donations. Donor advised funds are great for getting a deduction today, all kind of controlling those charitable outflows to the organizations for the next couple of years. The same goes for kind of some charitable led trusts. So keep those in mind if you're a high income taxpayer. The child tax credit is here to stay at the higher amount. It actually gets adjusted up to 2,200 bucks. And this one was set to sunset after 25 down to 1,000 bucks. So this is a win for most families with children, as kids aren't cheap. So $2,200 per child, and that'll be adjusted for inflation each year. So that's a big win for everyone. AMT, alternative minimum tax. So TCJA brought forward a higher exemption amount for AMT, and kind of what AMT is you figure out your taxable income as you normally would, and then on the sidelines you kind of run this separate calc. And this is where we joke that this is what tax software pays itself for, is to figure this out. But you start with taxable income, you add back and subtract certain preferences that are differ for alternative minimum tax purposes. And then you get down to essentially your alternative minimum taxable income. And if you're low enough under certain income thresholds, you kind of get this huge AMT exemption, kind of like a big standard deduction for AMT purposes. And that huge amount is here to stay permanently. And at the end of the day, you take that net AMT amount times 28% or 26-ish, and you compare that to what you had for income tax, and you pay the higher of the two. Prior to 2018, a lot of taxpayers were getting hooked by AMT, and we kind of have a chart to kind of show that. And going forward, when TCJA came about, really no one was paying AMT. And going forward with this higher exemption sticking around, it should be the same, except there's the phase out of that exemption will start to happen more quickly for high income taxpayers. So now it's 50% versus 25% of that AGI threshold. So you can kind of see historically, if you look who was paying AMT when it first came out, really nobody. We joke probably because nobody knew how to calculate it. There was probably not tax software. So when tax software came about, people started paying it now. And as we kind of went, here's where TCJA came into play in 2018. Literally no one started paying it. If the OB3 did not happen, roughly about an extra 2 to 3 million people would start paying AMT. We're thinking maybe around this kind of line is maybe where that higher exemption phase out will start clipping some high income taxpayers, but like I said, complete guess. Okay, another new provision and another campaign promise of Trump's was no tax on tips. So it's kind of complicated. He got some of it there. So it's a $25,000 deduction up to of total tips, and that's per return. So if you've got a married couple, or they have to file a joint to claim the deduction, and they're both in service industries with tips, they only get up to $25,000 total, which would be the same as single. You can't file separate for them both to get 25. You're stuck with 25 on that joint return. And again, this is a temporary deduction, so it starts this tax year, 25 through 28. There are AGI phase outs where you start losing on that deduction at 150 single and 300 as you climb over that. And the IRS actually just released guidance on what occupations qualify for tip income for this deduction. And we'll look at a couple of them on the next slide, but those were all now defined. So I put my tip jar away, so I will not qualify for the tip deduction. A lot of those, we could kind of joke about that, but they defined what a qualified tip was, and it's got to be voluntarily paid by the customer. I'm sure we've all been a part of a large party group where they put the automatic 18% tip charge on everybody's bill. That does not qualify for the tip deduction. It's got to be where the customer can do whatever they want if they want to tip and not tip. And again, since the IRS put out guidance of what industries qualify, just reminder, illegal activities don't qualify. So the drug dealers, if they get tipped, they won't be able to get the deduction. On the right side, you can see some of these industries that they've now kind of put out there. And you'll see on that first column, we've got this tip code. And kind of what we need to know as employers, if you work in service industries, is for 2025 W-2 reporting, there is no modifications for reporting this. For 2026, there will be extra codes for the W-2. There will be two codes. One will be the code that you have to provide to the employee of what industry they're in. I mean, anybody can look it up to figure out what they are if you're a server, a bartender, etc. But the employer still needs to provide that code, and that's for 2025 to the employee, either as in box 14 as informational or as an attachment. That code needs to be provided to the employees. In 26, there will be a designated code box for that to put that code on. And then the dollar amount that the employees can claim a deduction on, if the employer is already paying FICA tax on that, it's already on the W-2 in box 7. If not, they just need to reasonably estimate or do that on their own to kind of the employee needs to do something personally. Going forward in 26, the W-2 will be modified to add those boxes. So 12TP will be the tip income, and 14B will be the occupation code. And then here's the link to see what those tip codes are and some of those approved service industries that qualify for the tip deduction. And as a reminder, it's the individual claims the deduction. Employers still have to withhold payroll, FICA tax, and income tax on that income anyways.
Hey, Zach, I think a good question came into the Q&A that I just want to highlight here. Jake answered it in the Q&A, but question came in, do performance bonuses or anything like that count as tips, or is it just kind of that service restaurant? Jake provided the answer. It must come from the customer voluntarily, as you highlighted, and it must also come for very, very specific industries. Bonuses from employers would not qualify.
True statement. Okay. We're going to double down with the other campaign promise of no tax on overtime. So the maximum deduction will be for a married couple is $25,000. For single, it's cut in half at $12,500. And it's got the similar AGI phase outs at 150 single and 300. And again, this is temporary for 2025 through 2028. And the biggest thing, when you plain read the bill, they define it as qualified overtime compensation will qualify for the deduction, and it says defined by the Fair Labor Standards Act. So FLSA will determine whether or not that overtime qualifies for this deduction. And the big thing to point out is it's the amount you got paid extra for overtime, right? You only get to claim the deduction on the half in the time and a half. So if an employee earns $20 an hour regularly, and they work 42 hours overtime, so they got 2 hours at $30 an hour, that half of $10 an hour is the dollar amount that will qualify for the overtime deduction. And this is similar to all these other temporary deductions, these are not itemized deductions. They're in addition to itemized or standard. They're below the line. The 1040 has not been released yet, or the new draft 1040 to see what line that's going to be on. But there'll be the new Schedule 1A to show those deductions. And again, like it just applies to the time and a half. It's not holiday pay. If the employer pays extra for holiday time, that amount does not qualify. So the biggest issue is whether or not your overtime will qualify for this deduction. A lot of these industries probably do not, and there's actually been talks about a new bill to kind of fix that to get overtime for all industries. So farm laborers currently don't fall under FLSA, union workers, certain employees in certain states. Um, that's kind of that thing. So kind of for what do employers need to do for starting in 2025 this year. Again, for payroll withholding and FICA, there's no changes. The individual claims their deduction. The employees cannot self-designate the overtime amount. The employer has to tell the employee on their W-2 what the total amount of qualified overtime is. So that's a big thing, is different from tips. Because tips, employer does not have to pay FICA on them or include them, right? The employee can do that in their personal return and they'll figure out their own tip deduction. But the overtime piece, the employer has to tell on the W-2, right? For 2025, there's no changes to the W-2. So either it's an attachment to the W-2 or informational in box 14. And again, qualified overtime needs to be paid in accordance with FLSA. There's actually certain states that pay overtime on a per day basis. So if you go over 8 hours a day in California, you work 10 hours, so you get paid 2 hours of overtime, irregardless if you work 40 hours or not. FLSA is that plain written where it says you only have to pay overtime when you get excess of 40 hours per week. So kind of the big difference. So there's kind of some talks around some other professionals that some of these states, they might not qualify for the employees for an overtime deduction. Now, separate to the tips, there has been no regulations sent out on this overtime deduction yet. So as of today, there's a whole lot of questions of will or will not this qualify. I guess we'll see. It's a wait and see, but obviously that needs to come out here soon to figure out W-2 reporting. That's coming around the corner. Minnesota, for example, has got where they require overtime paid over 48 hours. But again, that's not in accordance with FLSA. It's got to be paid after 40 hours. So, and then last one, Brian, similar to tips, in 2026, they'll add a W-2 code to report that qualified overtime for the employee. Okay, and here's just the beginning snip of this new Schedule 1A, right? It's still in draft form, so this could completely change. But it kind of each part, I didn't snip the whole form, but each part is those new temporary tax deductions. So you got no tax on tips. Part 3 is no tax on overtime. I think part 4 is the auto loan interest deduction. And then part 5 would be the additional senior deduction. Okay, so overtime is a really heated, or probably a lot with still left unknown. If you aren't sure, start with your HR department to see if you're subject to FLSA. There's kind of debate about, well, what if I essentially treat myself as subject to FLSA and act as though I am? Maybe you might still qualify, but like I said, once regulations come out from the IRS and Treasury, then we'll know a lot more about who qualifies and what does not. Okay, the daycare flex. So for employees, they're able to potentially flex originally up to $5,000 of their wages into FSA, the flexible spending account. That's actually getting increased up to $7,500 starting in 2026. And I kind of just want a reminder that is per return. So if you're married, you and your spouse cannot both flex $7,500. It's one pot of $7,500. Again, that starts in 2026, and hopefully that'll help start curve the cost of daycare, and maybe that'll be about 1/2 about the current cost. Okay, the new Trump accounts. There is no acronym for it. It just got named after President Trump. These don't officially open until July of 2026, and we're kind of comparing them to kind of like a traditional IRA that's kind of has some non-deductible basis in it. So kind of like a non-deductible traditional IRA. And it's only for children under the age of 18. They have to have a social security number. And in addition, starting now in 25, if a child is born and through 2028, the government will actually put $1,000 into that Trump account. So if you're looking for a reason to have another child, there you go, $1,000 into their Trump account. So it's, I think, right, Wes, the accounts don't open until 2026. Children being born today, they should get funded because the government should have all the records via Social Security. So if you have a child that is born this year, just keep that in mind to see when that Trump account opens up. What kind of information gets remitted to taxpayers? I have no idea yet how this will get rolled out to everyone. But essentially, at the end of the day, the Trump account's only able to invest in certain funds, so essentially U.S. equities, and the overall management fee can only be 0.1% of the account value. And some kind of limits with it is $5,000 per beneficiary. An employer can actually contribute up to $2,500 into an employee's child's account, and that can be non-taxable compensation to that employee. And since the contributions are with after-tax dollars, you essentially, when you start to withdraw them, you have basis in the contributions, but the growth grew tax-free. So when you take that out, that'll be subject to tax. So you kind of prorate your basis as you take distributions out. You can't take anything out of the Trump account till the child turns 18. Again, yeah, there's no penalties. It just legally they cannot touch those funds until they're 18. They're still going to be subject to income tax, but again, you'll prorate that basis. And to not be subject to the early withdrawal penalty, so that 10% penalty, it's got to be used for higher education, start a business, buy a home, kind of stuff like that. A thing to point out is, for financial aid purposes, IRAs aren't part of the income test for a family or the student. So comparing to a 529 plan, maybe someone will prefer the Trump account more, so it doesn't affect financial aid. But again, with 529 plans, as long as they're used for qualified education expenses, those withdrawals are not taxed. Okay, a new tax provision is related to the sale of farmland was added to OB3. So it's got to be qualified farmland, meaning it was farmed for at least 10 years prior to the sale. So either you actively farmed it or cash rented it to a farmer. It's got to be located in the United States. But then after the sale, it's got to be legally enforced that there's a restriction on non-farm use of that land for 10 years after the sale. And kind of what this new thing is you calculate the capital gains tax on the sale. And instead of paying it all in that year, you can elect to pay it out in 4 annual payments for the next 4 years, spread it over the next 3 tax years. So it's a little bit different than an installment sale contract for deed, where kind of that installment sale delays the income tax until they get paid on that principal note. This new farmland sale tax election just spreads the tax out over 4 years. The tax is already calculated and moved on from. Okay, 1099-K reporting. The reporting on that was starting to get a lot more serious, where people are going to get a lot more 1099s from Venmo, Ticketmaster, all those ones, because the reporting threshold was dropping down all the way to $600 by 2026. We actually saw a lot starting in 2024 of clients where they received 1099-Ks from Ticketmaster for just getting reimbursed for tickets or trying to sell them at a loss. But now that's back up to 20,000, so a lot less people will see 1099-Ks again. Energy credits are essentially going away. So your solar, wind, those are going poof. So personal, so on your personal residence, if you're looking at putting any of this in, you have to have it installed by December 31st, 2025. And the same goes for the energy efficient home credits. So your energy efficient water heaters, AC units, doors, windows, you got to have it placed in service by the end of the year to qualify for the credit. The EV credit actually went poof 2 days ago. Businesses, so commercial projects, actually have a little bit more time for the solar and wind stuff. For solar, they have to about, I think, June 30th, 26 to have to start the project, money down, something, a contract. And then they have about till summertime in 2027 to fully finish that project to get the solar credit. But essentially, I'm sure we're all aware that with Trump's campaigning, yeah, they got rid of all energy tax benefits. So you just need to ask what you need to have done by and when, if you're looking at putting in anything energy efficient wise. Okay, I'm gonna pass it over to Jake Franklin for the rest of this.
All right, thanks, Zach. Let's see if I can actually take over control here. Here we go. So I'm going to cover the business provisions of the OB3. The first one that we're going to talk about here is bonus depreciation. This was set to phase down in Tax Cuts and Jobs Act. We were actually already in the phase down period. We were set to be at 40% for 2025. And now with OB3, the 100% bonus depreciation has been permanently restored to 100%. The effective date of that change is for property that is acquired and placed in service after January 19th of 2025. So inauguration day. If you went out on New Year's Day and bought a new truck for your business, that would still fall underneath the 40% bonus depreciation. So we will have, 19 days or so there where it's going to be under the old rules. We do note here that that there is I don't want to call it a potential issue, but just we are very specific in saying that it needs to be acquired and placed in service after January 19th, right? So back to that pickup example, right? If I bought it on January 4th, but I say that I didn't actually start using it until January 25th, that's not going to work because it does need to be acquired after that date. This also does affect long-term construction projects. So if we have a written binding contract, or if we're doing a self-construction project and we're more than 10% complete by or before January 19th, then we would fall under the old bonus rules. Last time with Tax Cuts and Jobs Act, there was some transition guidance that was released for the placed in service date, for that acquiring date. We believe that we're going to need the same type of guidance this time. We got pretty favorable guidance last time. It'd be great if we got that same favorable guidance this time, but we're just not there yet. Qualified production property. This is actually a completely new concept under OB3. We're allowed 100% bonus depreciation on, quote, qualified production property. So what is that? It's property that's placed in service inside of the United States, and it's got to be brand new. And I think the best way to think about this is factories, right? Manufacturing facilities, fabrication shops, places that are going to produce a product. This is a temporary provision, so we do need to have that property placed in service prior to January 1, 2031. It does exclude leased property. So again, without IRS regulation, on a plain face reading, I think we might have an issue with the normal way that we would structure a lot of these facilities is we would have a manufacturing activity taking place inside of a corporation. And then the real estate that is the qualified production property, we would usually put in an LLC and have that be taxed as a partnership. And then we would have a self-rental arrangement between that LLC and the corporation. The way that this is written, we think that may not necessarily work, and it may actually need to be inside of the corp. IRS guidance would be fantastic to know whether or not we can structure these the way we want to structure them. The portions of the building that are assignable to office space and parking lots and research and development, engineering, those other types of non-production type activities, those would not qualify for the 100% bonus. They would be under a normal 39-year property. This does need to be tangible personal property, and it can't be food and beverage prepared in the same building and be sold in the same building in which it was created. So I'm thinking like restaurants, breweries, potentially like candy shops, like that kind of stuff probably wouldn't qualify as a production property. So how is this different from the normal 100% bonus depreciation? So normal 100% bonus depreciation applies to property that has a depreciable life of 20 years or less. So its class life is 20 years or less. And normally like the building envelope of a factory would be 39-year property. And this applies to that building envelope. So it is literally everything that's depreciable goes. Not the land, that wouldn't go, but anything that's depreciable would go. So we would also caution people that if they're doing this with financed, if it's financed property, we may want to think about that right before we're taking 100% bonus, because those loan payments on that, there would be no deduction associated with those. Section 179, I think when I was in college, this was $25,000. And as of now, we are sitting at $2.5 million. So that has gone up quite a bit over the last number of years. Not going to say how many. The phase out also went up to $4 million. And so what that phase out is if I buy too much stuff, I can lose the amount that I'm eligible to take as a Section 179 deduction. So if I buy $5 million worth of stuff, I'm $1 million over that phase out. I'm going to lose $1 million off of that $2.5 million. I'd be eligible to take $1.5 million. I don't lose any benefit of the depreciation. It's just that's not eligible for 179. That $2.5 million number is set for inflation. So this leads me to a topic that's very complicated, and I'm going to probably way over explain it based on what this call is supposed to be, but I'm kind of trying to prove a point. And that is that if you have a Minnesota tax return and you have some of these items that have been affected by OB3, we're likely going to encourage you to extend your tax return. And I'm going to get into the reason why here. In North Dakota has what I would call rolling conformity, meaning anytime, right, every state starts at federal taxable income and then makes modifications to get to state taxable income. And North Dakota and Minnesota are no different. They both have modifications. But North Dakota has this rolling conformity. So anytime that there is a change to the federal tax law, it's just automatically adopted by North Dakota. You can see last week, the Bismarck Tribune had an article where they said that the state tax commissioner's office in North Dakota expects to see a drop of about $130 million in revenue over the next biennium. And that's solely from the OB3 impacts to the North Dakota tax returns. Minnesota does not work that way. So Minnesota is what we would call a static conformity state, meaning they adopt as a specific date. And that date currently adopted is May 1 of 2023. And the Minnesota legislature is not set to meet again until February of 2026. So I'm going to walk through an example of what this nonconformity means. There will not be a test at the end of this. You don't necessarily need to know the mechanics of it, but I just want to sort of scope out to you what kind of an impact this would have and why we're going to recommend you extend your return. So in this example, we have a Minnesota taxpayer that has $100,000 of 100% bonus depreciation taken in 2025. The property itself is a 15-year land improvement. So this is probably a parking lot. On the federal return, you see on the federal return here, we're going to bonus depreciate that thing and we're going to take a deduction for $100,000 and we're done. Under where Minnesota is probably going to end up after this next legislative session is they'll probably conform and they'll just make you add back 80% of that. But the way that it is now is they're not going to recognize that we actually took 100% bonus. They're going to only recognize that we took 40% bonus. and then subject the other $60,000 to depreciation. So here's the math as to how this works. On the federal return, we're going to have a deduction of 100 grand. On the Minnesota return, most likely, eventually, if they follow the same pattern that they've been doing for the last 20 years, we'll end up with a deduction of $20,000 on the Minnesota return. And the amount that's added back we'll get over the next 5 years. But if we were to file that return in February before the legislature takes session, right, we would have nonconformity and we would actually have a deduction of $11,000. So then what happens is we go through all this nonconformity work and we pay tax, only taking the deduction for 11,000. And then once the legislature changes the law retroactively, we then either have to amend the tax return or we have to wait for the Department of Revenue to correct it. Sometimes they can correct it, sometimes they can't. So that is why, right, told you way too much to tell you that extending a tax return in this example is probably a really good idea. The next change was to meals. So we've always basically had 3 different buckets of meals. And those buckets are what I would call business meals, holiday parties, and then these meals that are for the convenience of the employer. So for business meals, this is probably what we're classically thinking of as business meals, right? I'm on my way to a conference and I stop at the kiosk at the airport and get Chick-fil-A or whatever, right? That's going to be a 50% meal. Or I take a client out, that's going to be a 50% meal. There's no change in Tax Cuts and Jobs Act, no change in OB3. Has been static. Same thing with the holiday parties, annual picnics. It's essentially non-discriminatory, right? Everybody's invited. It's all employees. We're doing this for social reasons. Those are 100% deductible. Where things have changed is these meals for the convenience of the employer. And essentially what those are is, hey, we're in a rural location. I don't want you to leave the premise, or you can't leave the premise. And so I'm going to furnish you with a meal on site so that you can keep working and not leave. That is a meal for the convenience of the employer. And under TCJA, that dropped to 50%. Used to be 100% meal, now 50%. And under TCJA, in 2026, that was scheduled to go to 0% deductible, and OB3 did not rescue that one. It let it go. So in 2026, those meals will now be non-deductible unless I believe you're above the 50th parallel. So if you're doing this in Alaska, I think you're good to go. But anywhere else, you can't do it. All right, business interest expense. This is kind of a fun one. This is something that came out of the TCJA where businesses that had enough gross receipts, right? So essentially this year, you need to be in excess of an average of $30 million. You can have your business interest expense limited to 30% of your quote adjusted taxable income. And what was buried in that TCJA was that in 2022, the formula to define adjusted taxable income changed in 2022. So from 2018 to 2021, it was considered an EBITDA number. So earnings before interest, depreciation, amortization. And in 2022, they removed the duh. So we couldn't use depreciation or amortization starting in 2022. And now in 2025 and forward permanently, we're going to go back to the EBITDA formula. So I have another overly complicated example just so I can really drive home what the difference would be. Here's an example of someone who has $100,000 of taxable income. They have $60,000 of interest expense and $250,000 of depreciation expense. So we're going to compare 2024 to the new 2025 so you can kind of see how this worked. So in 2024, we were under this EBIT formula where I took my taxable income of 100, I added back my interest expense to get to 160, and then I took that 160 number times 30%. That's my ceiling on interest expense, right? I had 60 grand, I get to take 48, 12 is going to get suspended, and it gets suspended and it comes into the next year's interest expense. So we had a number of clients that were subject to this, and they were essentially always going to be limited. And so they were always going to have this amount that was carrying over and just building and building and building. And I think that our clients were not unique in that. I think this was sort of a problem nationwide. And so when we look at the change in the formula, where now we can add back this depreciation expense, we get to a higher adjusted taxable income number. Our cap, is that it triples almost, right? So now we no longer have that interest expense limitation. And in fact, a lot of those clients that I mentioned that have been subject to this, when that comes rolling into 25 as interest expense, a lot of that's going to start to unwind over the next year or two. Qualified business income deduction. This was a new concept from TCJA. It was set to expire after 2025. This was the deal that was, it was the trade-off where C corporations under TCJA received a tax cut from 35% down to 21% permanently. And the S corporations and partnerships and Schedule Cs, the flow through income type businesses did not receive that big of a reduction in the tax rate. And so they were given a 20% deduction of their overall income in order to essentially buy down that tax rate. And like I said, that was set to expire at the end of the year, and it is now extended. It is permanent. And they actually increased the phase-in ranges a little bit, where you had to have enough W-2s, and if you were in a service type business, you were not allowed to, if your income was too high, you didn't get to benefit from that deduction. Those phase outs have moved up by 25,000 and 50,000 single and joint. Excess business loss limitations. This was another new concept that was came out of the TCJA. This was also a temporary thing that was set to expire after 25. It actually got kicked down the road a little bit from a couple other pieces of legislation. And at the time of OB3, it was set to expire in 28, I believe. And now it's permanent now. So essentially, this is just you can't create large business losses, right? Take millions and millions of bonus depreciation and use that to offset investment type gains, capital gains, wages, that type of stuff. And so this thing is around to stay. The research and development, this is another change that happened in 2022 as well. There's a number of taxpayers that would do research and development credit studies. And of course, with that comes research and development expenditures. And historically, those have been able to be deducted as they're paid. And starting in 2022, we had to capitalize those and amortize them over 5 years. Now, we no longer have to do that. We can deduct them as we incur them. And in fact, those unamortized amounts from years 22 through 24 are, there's some transition guidance on how we're going to unwind those previously unamortized amounts. If you're a taxpayer that's less than 30 million in gross receipts, you can actually go back and amend those tax returns. Otherwise, for non-small taxpayers, you can you keep doing this if you want to, right? They say by all means you can continue to amortize your research and development, but they do provide you can basically unwind it entirely in 25, or you can split it between 25 and 26. So 1099s, like Zach said, 1099K thresholds went back up. In the normal, what I call normal 1099s, those thresholds also went up as well. So like the rent 1099s and the non-employee comp 1099s, those have been $600, right? If I pay somebody more than $600, I got to send them a 1099. That's been around for years and years, and that number is going to be $2,000 starting in 2026. And that number, I believe, will be adjusted for inflation. So we're going to have to actually remember what that number is every year now. Opportunity zones. This was the thing that came out of the Tax Cuts and Jobs Act. And essentially, the OB3 is going to sort of let that tranche of opportunity zones run their course. They're not really making any modifications to those. They're going to create a whole new concept or a whole new set of opportunity zones. The concept is that if you have a capital gain event, you can defer the capital gain if you invest the capital gain portion into an opportunity zone fund. There are some discounts on the tax. There's a deferral of the tax, and then there's a discounting of the tax. Um, with this new set, the deferral of the tax is 5 years, and the discount is 10%, unless it is a rural opportunity zone, and then the discount rate is 30%. So $100,000 worth of capital gain invested in, right? If it's a non-rural zone, you'd pay tax on the 90 5 years later. If it's a rural zone, you'd pay tax on 70 5 years later. Hold them for 10 years, and you can have a step up in basis to fair market value when you sell them, which is a fancy way of saying, right, they're tax exempt, essentially, if you hold them for 10 years. This new set, that tax exempt status does stop after 30 years, right? So there would be a mark to the fair market value of the basis at the 30-year mark, and then any gains that happen after those 30 years would then be subject to tax. One non-Big Beautiful Bill change to point out is there was an executive order earlier this year that has instructed the federal government to stop doing paper checks, meaning stop sending them and stop receiving them. This means that as of, I guess, 2 days ago, the IRS is not going to send out paper checks anymore. They need direct deposit information on all refunds. We're thinking that they may start sending out those prepaid debit cards instead of checks. Eventually, we will have to stop generating vouchers for estimated tax payments as well. And we will need to be using IRS Direct Pay or something like that in order to make the payments to the IRS. And then last but not least here, the estate and gift limits. Those were essentially doubled during Tax Cuts and Jobs Act. They were 13, I think maybe even almost 14 million-ish in 2025. In 2026, they were going to get cut in half, and they were going to go down to 7 million. And now under OB3 in 2026, that number is being reset to 15 million, and it's going to be indexed for inflation going forward. And that is a permanent change. So like Dan said earlier, there's our contact information. Dan, I'm going to turn it back over to you.
Yeah, I think we got a couple of questions here out in the chat that maybe we can just kind of clean up as we go. So first question we had, someone mentioned purchasing some tooling for an injection molding on a project. Is that going to be deductible under depreciable property?
Yeah, I would say yes. Yep.
All right. And then a couple questions on meals. Seems to be a hot topic. So, first off, if a business is supplying a lunch to all employees because most employees are staying on site for lunch, would that be deductible? And then kind of tied in with that, meals for all staff meetings, what's the deductibility on those type of items?
Yeah, if they fall under that for the convenience of the employer, then they're going to be non-deductible starting in 2026.
Yeah, it's kind of
So
a big change there.
yeah, that is a big change. Yeah, I mean, there's going to be some soul searching that happens as to what the purpose of the food is, right? What is this essentially to everyone as a social event, or is this to, hey, there's this team and I need you to not leave while we're working on this project and I'm buying you lunch? I'm thinking that's probably going to be non-deductible going forward in 2026.
Okay. One last one here. Any guidance issued yet on how fiduciary tax returns will be issued if the IRS does not have bank info for a 1090 or for a 1041 for a trust or estate?
Boy, that's a good question.
I thought so too. That's why I asked you.
I don't know. But the IRS really has not said
Okay.
much about
So
this.
no,
I think
no
the only
guidance.
guidance we have is that executive order. I think that basically what the IRS has said is keep doing what you're doing until we tell you to do it differently. But yeah, if we have a refund coming to 1041, yeah. Great question.
All right.
You could call them and
So as-
ask them today, but they may not answer.
Yeah. So as we wrap these up, I'll have Jake and Zach hop in and answer the remainder of these as well too. So anyone who wants to hang out, we will try to get through these questions. So really, that's going to wrap up today's session on the One Big Beautiful Bill Act, or OB3, as Zach called it, and then the tax changes tied to it. So big thanks to Jake and Zach for sharing their insights, and thank you to everyone for taking the time to join us. So as a reminder, this webinar was recorded. We'll be sending out a link to everyone who registered so you can rewatch it or share it with anyone else on your team or any other contacts you have. We'll also include, as you can see on the sheet here, our contact info. So if questions do pop up later, or if you'd like to talk through how these changes could affect your business or personal tax situation, you're going to know how to get in touch with us. We encourage you to reach out if you'd like to take a deeper dive or have a deeper conversation tailored to your unique situations. Our team is here to help you navigate those changes and uncover opportunities. Appreciate you spending part of your day with us. Look forward to connecting with you again. Have a great rest of your day.